this is me, Garima, saying I hope you all are doing well. Today our topic is money and banking. We have already discussed this first part where we discuss the evolution of money, attributes, and few more topics. This chapter we have already covered. This we are doing. In first part I have covered 3-4 topics. The second part what I'm gonna cover is importance of money, legal, functional, and broad, narrow definition of money. Classification of money, monetary system in India, money supply, its meaning and its measure, change in money supply and its determinants. Let's move on to our first topic. What is importance of money? Money occupies a unique position in a modern capitalist economy. In its absence, the whole prosperous economic life would collapse like a pack of cards. The advantage or uses of money can be best understood by considering the system in which money is absent. First important is money has overcome drawback of barter system. We have read drawback of barter system which make exchange process unwidely and highly inefficient. In fact, money was invented by the society to overcome these drawbacks. The barter system suffered from four main drawbacks, like money as a medium of exchange solve the barter's problem of lack of double coincidence of want. Money as a measure of value or unit of account solve the barter problem of absence of common measure of value. Money as a store of value, the barter problem of difficulty in storing wealth. Moreover, money in convenient denomination like 5, 10, 20, 50 paise and currency notes of these solve the barter problem of absence or lack of divisibility. Money as standard of deferred payment helps to solve the difficulty of borrowing and lending involved in the barter system. It helps to make contract which involve future payment. Doubtlessly, money helps in removing the difficulties of barter system. So, in many ways, money has overcome drawback of barter system. Second is it facilitate exchange of good and services and help in carrying trade smoothly. The present highly complicated economic system will not exist without money. Third is money help in maximizing consumer satisfaction and producer profit. It helps in promote savings. Fourth is as it is money promotes specialization. Fifth, it facilitates planning of both production and consumption. Money can be utilized in reviving the economy from depression. Money enables production to take place in advance of consumption. It is the institution of money which has proved a valuable social instrument of promoting economic welfare. The whole economic science is based on money. Economic motives and activities are measured by money. In fact, money makes its appearance in every phase of economics. In the word of Marshall, money is the center around which economic science cluster. So these are number of importance of money that we discuss. Now we move on to second topic, that is definition of money in various terms like legal, functional, broad, narrow. Money should be defined what money is. Money has been defined differently on different bases like legal acceptability, its function, scope, etc. First one is legal definition of money. According to this definition, money is what the law says it is. Anything will be called money if law proclaim it as it is. Thus, it is a legal tender money since it has a legal sanction by the government as a medium of exchange. Legal tender, it means money under the law of land. It is the money issued by monetary authority or government which cannot be refused by any person. It constitutes by law the sufficient discharge of debt. The government issue an order stating what is money and that become legal tender money. Everybody is bound to accept it in exchange for goods and services and in discharge of debt. None can refuse to accept it because non-acceptance is an offense. In India, currency and coins are legal tender money which cannot be refused in payment of transaction. Other is non-legal tender money. This is also called optional money, but it is generally accepted as a money on the basis of trust and their issuer command. It compromises credit instrument such as check, draft, bill of exchange. Now in next slide we're gonna discuss legal tender. It divided into two parts: limited legal tender and unlimited legal tender. Limited legal tender, which can be accepted only up to a certain maximum limit fixed by law. For instance, the 5, 10, 20 rupees coin are accepted at a maximum sum of 25. Nowadays, minting of these coins has been stopped by Government of India. Unlimited legal tender is the money for which there is no limit to the quantity of money offered in a payment at a time. For example, in India, paper notes are unlimited legal tender because all currency note can be issued to settle payment of unlimited value. Remember, currency note of the denomination of rupees 2 and above are issued by RBI, whereas 1 rupee notes and coins are issued by the Government of India. Now, what does legal tender include? Legal tender include limited legal tender, unlimited legal tender. Here coins, here paper notes. Now we move on to that is non-legal tender. Non-legal tender include check, draft, bill of exchange, and other kinds of bank note. Now we move on to functional definition of money. It is defined in terms of its function. According money is that which money does. It is based on the four functions of money already discussed. Broadly, anything which is generally accepted in payment of debt and as a payment of goods and services should be included in money supply. Alternatively, if a good is generally acceptable in payment and generally used as medium of payment, it should be treated as money, no matter what its legal status is. Thus, in India, money supply include currency, that is coin plus paper money, which is endowed with legal tender power, and deposit money. What is narrow versus broad definition of money? Narrow definition of money based on medium of payment, that is M equal to C plus DD, where C is the currency, D is the demand deposit of banks. It's said to be narrow definition of money. This anything which is used as a medium of payment is included in narrow definition of money. What is broad? It is the broad definition of money when scope of money is extended to include store of value, function in addition to medium of exchange. Its symbolical formula is C plus DD plus TD plus SD. C stands for currency. D is that demand deposit. The both include narrow. Then TD is time deposit. Saving SD is saving deposit at both post office. Also included in broad money because such financial assets have a high degree of moneyness and are close substitute of currency. Here there is a topic also named money and near money. A distinction between the two will be informatory. Money is anything which is used as a medium of exchange and has a legal sanction of the government. It possesses 100% liquidity. Near money is a close substitute of money rather than cash and currency. It is as good as money, but it is not real money because it has no real sanction as money. Assets which are close substitute of money are near money. Example like bond, equity, shares, NSC, National Savings Certificates. Now we move on to our third topic, that is classification of money, divided into 5 classification: full-bodied, representative, credit, fiat, high-powered money. The first one is full-bodied money. It is the money whose value as a commodity for non-monetary purposes as great as money. In other words, it is money whose face value is equal to its intrinsic, that is metallic value. Its value as a coin is the same as its value as metal. Full-bodied money can be both metallic as well as representative money, generally made of paper money. Full-bodied metallic money is standard coin when the economy is on metallic standard, that is gold coin in a gold standard, silver coin in a silver standard. Standard coin refer to those coin whose real or intrinsic value, that is value of metal, is equal to the face, that is printed value. For instance, if value of metal used in a 5 rupee coin is equal to 5 rupees, it will be called standard coin and recognized as full-bodied money. Second is representative full-bodied money. It is generally made of paper money, although paper money has no value as commodity but represent in a circulation an amount of money with a commodity value equal to the value of money. It is 100% backed by a metallic reserve and it is fully redeemable in some precious metal. It is equivalent to a circulating warehouse receipt for full-bodied coin or their equivalent in bullion. In other words, it is equivalent to the reserve kept in the form of gold and silver and foreign currency against the amount of notes circulated. This type of paper money is called representative paper money because it represents in circulation an amount of money with commodity value equal to the value of money. The benefit of representative paper money is that it can be conveniently used in trade in which large amount of money is required. Third is credit money. Credit money refers to money whose face value is greater than the commodity value of material from which the money is made. For example, token, coin, currency notes, checks. Since it is made up of cheap metal or paper, its official purchasing power is higher than the value of its content. For this, the government limits the quantity of money by preventing the free and unlimited transformation of the commodity into money. Credit money of various forms like token coin, representative token coin, circulating promissory notes issued by central bank, deposits in bank like saving deposits, time deposit, credit card. A line about credit card will be informative. These days, some of the nationalized banks have started issuing to their customer credit card, which are thought not money by themselves but can be issued like money as medium of exchange. Fourth one is fiat money. Fiat money is any money backed by order of the government to act as a money. Fiat money is money with no intrinsic value. It is that type of paper money which is convertible. It circulates in the country on the fiat, that is command of the state. Fiat money is generally created and circulated at the time of crisis like war or emergency. Since it is issued without any backing of gold, silver or other reserves, therefore it is not convertible into anything than itself. It has no fixed value in terms of any objective standard, leading sometimes to doubt about its acceptability. Fifth is high-powered money. High-powered money or monetary base refer to the money produced by RBI and Government of India. High-powered money is symbolically represent high power equal to C plus R plus D, where C is the currency notes in the hand of public, R cash reserve of commercial banks, and OD is the other deposit of RBI. This is what classification of money include. Now we move on to what type of monetary system we have. Like India at present follow the paper currency standard, as everybody know, because here standard currency is made of paper. This is also referred as managed currency standard because any amount of note can be issued with minimum backup of gold worth rupees 15 crore. Remember, monetary standard is the type of standard money used in economy. It is legal money through which government discharges its obligation. The standard money which is used in India is made up of paper. In India, the monetary authority is Reserve Bank of India, which has adopted a standard currency made of paper. That is why India is said to be in paper currency standard. Few points need to be keep in mind, like paper currency is the main currency of the country. It is an unlimited legal tender, which means that it can be used to settle debt and make payment up to an unlimited amount. Coin made up of cheap and light metal are used for making smaller payment. Again, these coins are limited legal tender because they can be used for making payment and settling debt only up to a limited amount. Second is RBI has the sole monopoly to issue currency note in India from rupees 2 and above. The Ministry of Finance issue 1 rupee note and coin. Third is minimum reserve system. The system which governs note issue in India is the minimum reserve system, according to which the central bank keeps a minimum reserve of gold and foreign exchange, and on this basis can issue note to any extent. Since paper currency is not convertible into precious metal like gold which is backing it, therefore currency is said to be inconvertible. Now we move on to fifth topic, money supply, meaning and its measure. Meaning, the supply of money means the total stock of all form of money like paper money, coin, demand deposit, which are held by public at any particular of time. Supply of money is a stock variable because it is related to any point of time. The stock of money with RBI and banking system is not included in supply of money. Here the term Public include all economic units like household, firm, local authorities, non-departmental enterprises of government. The government and the banking system are not included in public sector because they are producer of money, and the producer of money are central government, Reserve Bank of India, and all the banks which demand deposit. Source of money supply, basically producer of money. Source of money supply is government, RBI, commercial bank. Measure of money supply. In India, Reserve Bank of India uses four alternatives: M1, M2, M3 and M4 used for money supply because its components are regarded most liquid. Each measure is briefly I'm gonna explain. First one is M1. Symbolical formula is this. C denotes currency held by public. D stand for demand deposit in bank. It not CD, it should be OD. Here it is wrong, it should be OD. Here C denote currency notes, not CD, it should be OD. That stand for other deposit in RBI. Demand deposit are deposit which can be withdrawn at any time by the account holder. Current account deposit are included in demand deposit, but saving account deposit are not included in DD because certain conditions are imposed on the amount of withdrawals and number of withdrawals. OD stand for other deposit with the RBI, which include demand deposit of public financial institution. It should be OD. I think I should correct it right now, otherwise some student gonna write it like it is. As it is, it should be OD. C for currency with public, demand deposits, other deposits with RBI. So I've discussed M1. Even but saving account deposit are not included in DD because certain conditions are imposed on the amount of withdrawal and number of withdrawal. OD stand for other deposit with RBI, which include demand deposit of public financial institution, demand deposit of foreign central banks and international financial institution like IMF, World Bank, etc. Second is M2. Here M1, the detail which I have discussed should be included, plus saving deposit with post office saving banks. Third is M3, M1 plus net time deposit of banks. M4, M3 plus total deposit with post office saving organization excluding NSC. In fact, a great deal of debate is still going on as to what constitute money supply. Saving deposit of post office are not a part of money supply because they do not serve as medium of exchange due to lack of check facility. Similarly, fixed deposit in commercial bank are not counted as money. Therefore, M1 and M2 may be treated as measure of narrow money, whereas M3 and M4 measure of broad money. In fact and in practice, M3 is widely used as measure of money supply, which is also called aggregate monetary resource of the society. All the above four measures represent different liquidity in terms of different degree of liquidity, with M1 being the most liquid, M4 being the least liquid. It may be noted that liquidity means ability to convert an asset into money quickly without loss of value. Now the last topic is change in money supply and its determinants. What brings change in money supply? Clearly, money supply will change when magnitude of any of its constitute change. Let us for the sake of simplicity use most liquid definition of money, that is this one. Clearly, change in C held by public, DD and net time deposit of bank will cause change in money stock as well. In addition, various section of RBI and commercial bank as well as preference of public for holding cash balance vis-a-vis deposit in bank affect money supply. These are summarized in the form of three determinants, 3 points like CDR, currency deposit ratio. It is the ratio of currency held by public to their holding of bank deposit. that is CDR. Second is reserve deposit ratio. It is a proportion of total deposit which commercial bank keep as reserve. Bank hold a part of money from people deposit as a reserve money and loan out the balance to various investment projects. Third is high powered money, the total liability of the monetary authority of the country. RBI is called the monetary base or high powered money. Even money creation by RBI has been done. Money multiplier is the ratio of total money supply to stock of high powered money in the economy. This is all about changing in money supply and its determinants, that what I have discussed. That's all for today, but if you know more about money, you can just log on to this website paisaboltahai.rbi.org.in. Here you know more about bank notes in brief. Just click and know more about and all those things. Just log on to this website and know more about notes and currency. Here, like, it's what does it includes and all, just in briefly given here. So do check it out, this website. That's for today. Next class I'm gonna discuss commercial bank and few questions related to this chapter, money and banking. That's for today. Thank you.